So we started to talk about the international trade financing last week, and on Monday we went through the risks that were involved, and then we went through the process, and then we on Friday we talked about the actual letter of credit and how it's universally enforceable, irrevocable, and it actually deals with all our the risks that we mentioned that involve international trade. So this week we're talking about how to finance international trade, and we'll talk about post-shipment financing, pre-shipment financing, exim bank financing, and then we'll talk about some parties involved and how the process works, and how it actually can be possible given all these complications with the international trade. So some of the risks that we mentioned started out with payment-related issues. So, the letter of credit actually addresses this quite nicely. You have two banks that are correspondents with each other, and they usually, most of the time, overwhelmingly most of the time, these two correspondent banks will be handling the payment arrangements the for the international trade. So because you're working with correspondent banks and they are, in a way, agents of each other, the simultaneity of exchange, the products and the money is never an issue. And unless the goods are, or once the goods are on board the ship, free and clear, and everybody signs off on it, and you have the banker's acceptance, then the payment becomes due if it is a site LC, or the clock starts ticking if it's a deferred LC, and the banks will be involved with respect to the payment. So it kind of takes care of these two. Well, not kind of. It actually takes care of these two, and then obviously with letter of credits, there is no actually post-delivery issues, refunds, or returns, because the goods are on the ship after an inspection, who is acting on the importer's behalf, and also for the benefit of the exporter as well and all the parties involved, and they make sure that what is being ordered is what is being shipped. And if there were any reservations, the importer was made aware, and negotiations took place between the importer and the exporter. Penalties were enforced. But once the goods are on board, free and clear, and everybody signed off on it, this is irrevocable. There are no returns, there are no refunds, and no post-delivery issues. If anything happens to the ship or the cargo on the way, then you have the logistics company to deal with, the insurance company to deal with. But once the exporter puts the goods on the ship and everybody signs off on it, from an exporter's point of view, that sale is final. So the banks usually take care of that legality of the payments and how international actual transfer takes place, acknowledgement of receipt of funds, conclusion of the letter of credit with respect to the payment, the timing of it, and then all of that is handled by the correspondent banks that are involved with the international trade, the exporters bank and the importers bank that are correspondents with each other. Usually, the banks who are involved will also handle the taxes, duties, and the regulation. However, logistics companies will also provide assistance, but ultimately it's upon the importer, and the importer needs to make sure that the goods will be are okay to be imported, and all permits are secured, and all transfer orders or transfer permissions are obtained, and the banks will be helpful, but ultimately it is the importer's obligation to carry that out. So with respect to the delays and accidents and unintended issues or intended issues, and the location, these are all specified in the LC, the letter of credit, and the logistics company will ensure proper delivery to the proper location as specified with the LC. There will be penalties specified in the LC with respect to delays, and if there are perishable items, then ultimate final penalties to be enforced to the exporter or to the logistics company and to the insurance company. If there are any intended issues, again, from an importer perspective, your agents are on the site, and those are the inspection guys, the, um, the port authority, the customs authority, and usually importer is not um, at the at fault usually, but the exporter, they actually have to clear their products through customs, and they have to have the logistics company, the insurance company, the customs, um, offices or authority, the port authority, and sometimes the World Health Organization or trade organization, and all of those international organizations representatives on locale will be inspecting the product or can actually inspect the products at random. And the product related issues are usually, again, handled by the inspection process. Remember, at the beginning of the LC, we specified that we make sure what we want is very well specified. And I gave you the example of the corn that, in my experience, there was the shock and awe for me. Corn is corn, but it turns out not really. There's so many different kinds and DNAs and the humidity and mold, moisture, and all that. I mean, it's just whole another world. And I've seen the reality of agricultural engineering, and but all of those are specified at the time of opening the LC, and therefore, the inspection company is the company who helps us define the product that we are importing, and their agents at the exporter site will be the company who will be making sure that the products that are being loaded to the ship or into the container are the same products that we actually intended to import. So the damage, the condition, different product, usually the different product is caught at the exporter site. Damage can happen en route, and the condition also can deteriorate en route. And there we have the insurance, and we want to make sure that we include all sorts of damage that can potentially happen, and any sort of condition deterioration. We want to include that in the insurance as well, and we want to make sure that the products that we receive are in the condition that we want to receive them. Going back to corn, it's one thing to receive the corn that you ordered, and it's a whole another to receive it with significant deterioration so that it cannot be sold for health reasons. Obviously, we have the legal issues, but these are usually handled by either the banks involved or the export country customs and the import country customs. And remember, you need a permission to import, at least a clearance to import, and therefore, at the beginning of the LC, usually banks will require that you obtain these permissions and certificates or whatever that's needed by the specific country that you're in. And we also said that there were some issues as to the insurance and logistics, and these are usually taken care of at the time of opening the LC. So we started out the process with a pro forma invoice, and we said that we had issues with payment, logistics, insurance, product description, legalities, representation, and intermediation. So after we resolve these issues, get the proper certificates, permissions, regulatory requirements, and choose our bank and make proper connections with the exporter and make necessary agreements with the insurance companies and inspection companies, we move on to the next stage of invoice. So the banks will be handling, well, the parties involved with this transaction are the importer and the exporter, and then we're going to have the exporter's bank, the importer's bank. They need to be correspondents, and they need to accept to work with each other as agents of each other. Then we have the logistics company, for obvious reasons, the insurance company, inspection company, the government. Actually, this I think needs to be plural. So it's not just the exporter's country or the government, it's also the importers, but you might actually have countries in your transit route that might actually get involved. If you're going to be crossing any channels like Gibraltar or Panama Canal, you might actually need permission to cross or at least pay the fee, things like that. So we need the exporters bank and importers bank, and we also said that the payment can actually be made by a third unrelated bank, and we're going to talk about that today. So once the invoice is issued, that means we're going ahead with this, and everybody agrees to the terms of the LC, and we choose. The exporter chooses the bank, importer chooses the bank, and we make sure that they're correspondents and they're agents of each other, and their correspondence includes the amount of LC that we want to open. So, if it is a large LC, say $100 million, we want to make sure that both banks are okay, trusting each other for that amount. Then we write a contract, and universally this is referred to as a letter of credit. And it's just a contract that includes all of these issues, and it specifies that it's irrevocable. It will have penalties. It's a thick document. It will have jurisdiction on it, but more than likely, there's the international arbitration that usually handles the letter of credit, disagreements. Then we need to define how long of a process we are looking. That usually starts with the opening of the LC all the way to the delivery of the products. The payment term usually is not considered to be part of the LC. It's a commitment by the exporter's bank and the importer's bank, and as soon as the goods are on board, free and clear, usually letter of credit is considered to be fulfilled. And from that point on, if it is a site LC, at site LC, the payment is due immediately, that very same day, and the interest will start ticking, and you will be at default if you don't pay. If it is a deferred LC, then the clock starts ticking. So if it is, say, 30 days, then from that point on, the goods are on board, free and clear. At that point on, you have 30 days to actually deliver. If it is a 6 months, then from that point on, you've got 6 months to deliver, and it can actually be any days. And we said that not every letter of credit will come with a payment confirmation. However, it's an incredible rarity to have a letter of credit that doesn't have a payment confirmation. So you're looking at most of the letter of credits that includes a payment confirmation. Payment confirmation simply says, from a bank perspective, that says if the importers does not pay, we will pay. So don't worry about it. So from an exporter's perspective, once you receive the payment confirmation of a bank, it simply says that you couldn't care less if the importer pays or not. You actually have a bank that says, I will make the payment. And that's usually really, really a good feeling to receive that payment confirmation. And therefore, most LCs are actually confirmed for payment. So a payment confirmation can come from anyone. It actually can be the even exporter's bank. However, it's a lot more common for the importer's bank to provide that payment confirmation because they're in the local, they're in the same locale with the importer. They can take collaterals for that confirmation. They could require down payments for that confirmation. They could require co-signments for that confirmation, co-signatures for that confirmation, and it's much more convenient and easier for the importer's bank to obtain these legally binding collaterals so that they can provide the payment confirmation. However, there's no rule that says that the importer's bank has to be the payment confirmation bank. It can actually be an unrelated party. Like, for instance, when I worked in Turkey, even though the letter of credit was handled by, so in the case of, say, for instance, in Bosnia after the Yugoslavian war, when the Bosnian banks wanted to, do international trade, their payment confirmations were not accepted. So as a Turkish bank, we were providing a payment confirmation for the international trade, or the LCs, opened by Bosnian banks. We did very similar transactions for banks in Azerbaijan, and when their payment confirmations were not accepted as a well-established Turkish bank, we were happy to provide payment confirmation for our correspondent banks in Azerbaijan. Of course, we didn't do this free. We charged money. We did it for money. However, that's how banking works. We're not, the banks are not charity. I mean, we do everything for money. So, at this point, the idea becomes, how do we actually finance this, and where does the financing come in, right? So let's, so the first we will talk about what we refer to as post-shipment. So the post-shipment is actually the easiest, and then on Wednesday we'll start talking about the pre-shipment, which is really, I mean, it's not complicated at all, but it's not really fun from a bank perspective. Post-shipment is usually very, very straightforward, and most banks are happy to provide it, right? So there's a sequence of events that needs to take place, right? So everything starts with pro forma invoice, and then we actually have invoice. Oops, if I could spell. And then we have the actual LC. And then let's say that this is a confirmed LC with a 30-day deferred. Right? So, and then what we're going to have is delivery of goods to the ship. So, goods are free and clear on board. So that's actually, oops, sorry, that's actually the most important part of all this. So, I mean, you can usually have this at day one. I would say the invoice would actually come somewhere around like, I would say plus 2 weeks. I would say after the invoice, you're probably looking at about a month. And then from the LC opening to delivery of the goods, I mean, obviously this can change depending on the product. Let's just say a month, right? And then the actual clearance by inspection, by the logistics company, the insurance company, government, and this is usually about a week. So these are all examples based on my experience, but obviously depending on the goods, these can vary significantly. If it's a perishable item, these would probably stay the same. These probably would stay the same. This probably would stay the same. This can actually be a day. So depending on the product, things will change. If this is like a construction project internationally, then this can be up to a year or maybe even more. It could be parts of the project as they can stand by LC as they complete it, they would actually get paid. It can get longer. So, anyways, so once the goods are free and clear on board, now we actually have 30 days of payment. So at this point, the exporter sent the goods and waiting for the payment, right? So, and this is say after the day goods are free and clear. So free and clear delivery, day number one. Now at this point, free and clear day number 30, exporter gets paid. Very simple. Right? So the issue now is the shipment is sent, and that's why the term post-shipment financing. Now, at this point, the exporter might actually want to get paid now. And I know the exporter agreed that he will wait for the payment for 30 days, not because he wanted to, but because, I don't know, he had to. Motivated seller. And an importer had the upper hand, and they actually got that 30-day, or this is the usual, it happens in that specific product market. However, the exporter sent the goods and they will get paid in 30 days. They just want the money now. So what then we can do is we can actually have a bank. a bank, right? So this can be any bank. It can be the importer's bank, the exporter's bank, completely unrelated bank. It could be the bank around the corner. It could be the bank in South Korea. It could be the bank in India or South Africa or any country. A bank uh, pays the exporter, right? So this can be the same day, but usually takes a couple of days. So about, let's just say day number three. Like I said, it could be the same day if you could make the arrangements beforehand, or once you have the banker's acceptance after the goods are free and clear on board. You do have a couple of days. I mean, the exporter just wants the money as soon as possible, not exactly the day one, but if you could arrange that at the time of the LC, then you could literally have the bank, the financing bank, deliver the money same day. So a bank, and I'm just going to type in financing bank, pays the exporter. It's very simple. And at that point, the exporter will sign off the future payment to the financing bank. So the exporter signs the future payment to the financing bank. And that's it. The exporter received payment. And so let's just say the invoice is for $100,000. At this point, the exporter wants to have the payment $100,000, but obviously that's not going to happen because the bank does not do this. The financing man does not do this out of the goodness of their heart. They probably will pay them, say, I don't know, it's 1 month, so about say $95,000. Right. So from the exporter's point of view, they're actually paying $95,000 for a future payment of $100,000. So, like I said, the financing bank is not doing this out of the goodness of their heart. They will pay the exporter a discounted payment of $95,000, and their expectation is that they're going to receive $100,000 in about 30 days. So at this point, since the exporter signed the future payment to the financing bank, on day 30, financing bank gets paid by the importer's bank, and they will get paid $100,000. So from a financing bank perspective, they paid out $95,000 to the exporter on day number one, and then they will receive $100,000 from the importer's bank as, remember how this is confirmed and a 30-day deferred payment. So that is the payment for the LC. It's just the exporter is receiving it early from the financing bank, and the bank and the financing bank is basically just paying the discounted money. So for them, in about 29 days, they made $5,000 out of $100,000 of the payment. So what is their guarantee? From a perspective of the financing bank, they have a guaranteed payment confirmed, a confirmed payment from a US bank in our example, right? The confirming bank is the actual payer. Because remember, a payment confirmation simply says that if the importer doesn't pay, the confirmation bank will pay, or payment confirmation bank will pay. Therefore, from a financing bank perspective, our risk has nothing to do with the LC, has nothing to do with the actual transactions. I couldn't care less what the products are. I don't even care. Because remember, I only paid $95,000, or I only financed the operation once the goods are on the board, free and clear. Meaning everybody signed up on it, including the government, including the customs, including insurance, logistics, the inspection, the importer, exporter, importer's bank, and we have the banker's acceptance. Everything is done. And only then the payment is due, and only then the financing bank actually pays. So once that's the issue, um, from a financing bank perspective, I have very minimal risk because importer doesn't pay. I don't care. It's a confirmed LC, and the confirmation bank will pay. So from a financing bank perspective, the only risk I'm taking, whether the confirmation bank, payment confirmation bank will pay or not. And if it's a reputable bank, then I have nothing to worry about because they will actually, I'm hoping that they will actually pay. And my financing is about $5,000, and that's my profit. And from the perspective of the for the exporter, I mean, it was $100,000 sale, but they received a $95,000. But rather than waiting 30 days, they actually got paid today. So everybody goes home happy. That's post-shipment financing, number one. So in this case, by the way, a few things. Who gets financed? Well, the exporter, right? So who receives the financing? The exporter. Who pays the cost of financing? And that's also the exporter. Simple, right? So we have actually a post-shipment financing number two. So what I'm going to do is I'm going to get this. Oops. Sorry. And then we're going to copy, create a new sheet, paste it here. I don't need these two, and I don't need these two. And I'm going to call this post-shipment number two. So in this case, one thing that we actually have different is that we have the pro forma invoice, the LC confirmed, except it's going to be at site. So at site actually works better for the exporter because the exporter gets paid immediately and the importer is at a disadvantageous point where he has to make a payment immediately. And in this case, the importer does not or cannot pay immediately. So why would they agree to this? Again, it could be how the market is for these products. It could be that the exporter has the upper hand. They may be selling a premium product and the importer may not have any other alternatives. But either case, importer has to make a payment. So very similar to what we had before. This is, oops, need to copy this. The exporter sent the goods and waiting for the payment. And in fact, believe it or not, payment confirmation bank pays. That's it. They don't even wait for the importer to pay. It's very straightforward. Payment confirmation bank will immediately pay. And then payment confirmation bank will ask the importer to pay the same day. Everything is happening on the actual shipment date. The goods are free and clear on board, and that's the day that everything becomes due. So, as an importer, I did agree to make the payment, okay, because I didn't have a choice, but I don't have the money. I'm going to receive the goods, sell them, then I'm going to have the money, and then I'm going to pay. But the payment is made. Now I have to make a payment to the payment confirmation bank, right? So then what I will do is at that point, I'm going to ask for a financing bank pays the payment confirmation bank. So as the importer, I will find a third unrelated bank, or it actually can be any bank. Like for instance, I could go to the payment confirmation bank, which could be the importer's bank, which could be my bank. And I could say, okay, I know a payment is due today, but can I actually pay you in, say, 90 days? They might say no, which then the payment may be due exact that same day. They might say yes, but it will cost you money, interest. I may be okay with it, maybe too much. Or I could find a third unrelated party, it doesn't even have to be my locale. Anybody who's willing to pay for me can be the financing bank. But I have to make a payment that day. So I need to find and make these arrangements beforehand, possibly right around the time that I actually open up the LC. Since I already know, what's going to happen, I should actually make all these arrangements because unlike the post-shipment number one, I don't have the luxury of waiting. My payment is due that day, sometimes by the hour. So in any case, so the financing, let's just say that I found the financing bank who's willing to pay the confirmation confirming bank. What they're going to do is they will actually pay the $100,000. Now remember, the LC for this example said that it's $100,000. So the payment confirmation bank will be paying $100,000, and then they will ask the importer to make that payment, and then the financing bank will actually pay the confirmation bank $100,000. And then let's say that we agreed on 90 days, and then the importer pays the financing bank. Now, at this point, obviously, I got to pay interest. So, say for about 3,090 days, just as an example, I'll pay them $110,000. So, as you can see, at this point, because this is a site LC, I have to make a payment as an importer. I have to make a payment on day number one, and that payment, and if I don't have the money, I will be at a default. The exporter already got paid. The payment confirmation bank will actually pay the exporter. So the LC at that point is done. So at this point, the only thing that's outstanding is, as an importer, my debt to the payment confirming bank. And remember, to get that payment confirmation, I put my house as a collateral, or I have other collaterals, so the payment confirmation bank can actually close on them. So to avoid this, I have to make a payment. I could ask the payment confirmation bank or any other bank to help me out and make that payment that day, and we refer to this as the financing bank. So remember, the financing bank, the payment confirmation bank can actually be the same bank, or they can be different. And it could be the importer's bank, it could be the exporter's bank, it could be a totally, completely unrelated bank. As long as everybody agrees to the binding contracts of payment, everybody goes home happy. And then, how many days of financing I need, it's completely up to me. How many days I can find financing, how many days I'm willing to pay for financing. And once I do make that arrangement, and when the day comes, I actually make the payment. So at this point, oops, who gets? So we have two questions. Who gets financed? Well, in this case, the importer. Because remember, this is at site. The importer needs to make a payment immediately, and importer is trying to defer that payment. And who pays the cost of financing? Importer. So with the post-shipment financing number one, we said that this is a 30-day deferred payment, and therefore the importer is expecting, well, in this case, the exporter agreed to a 30-day deferred payment. So the importer actually has 30 days to pay. However, the exporter wants the payment as soon as possible. So exporter gets financed and exporter pays for finance. In the post-shipment financing number 2, well, in this case, this is at site, which means as soon as the goods are on board, importer needs to make a payment, but the importer needs time, and importer asks for financing and gets financed, and importer pays the cost of financing. So the process is actually very, very simple, and the risks involved in this is relatively low, simply because, I mean, again, for the financing bank, the risk involved is relatively low. And when I worked in international finance, we loved these transactions simply because from a financing bank perspective, the only risk that we're taking is the payment confirmation bank. If the payment confirmation bank is good for the payment, then I don't care if the ship sank from a finance perspective. And I don't care if the goods get damaged. I don't care if the importer and exporter have a dispute. I don't care if the LC crumbles down. What do I care? Payment confirmation bank confirmed the payment. To me, that bond is what I'm financing. So the transaction is the underlying cause of the financing. However, from a financing bank perspective, this is a sweet deal simply because I'm actually financing the payment confirmation bank. And in this sense, the post-shipment financing number 1 is quite nice. Now, post-shipment number 2, there's a bit of a problem. The problem is that the financing bank is actually financing the importer. In this case, remember, the financing bank is paying the at-site LC, which means even the payment confirmation bank and everything else is now out of the picture, right? Now, remember, with the deferred LC, the payment confirmation bank is the one that's actually guaranteeing the actual payment, right? With the at site, there is no such payment, the guarantee. So if the importer fails to pay in 90 days, it is upon the financing bank to get that payment. So it's a little bit tricky now, because now the financing bank has to get the collateralization and has to ensure that the payment will be happening in 90 days. And if it doesn't, they have a plan B. So that concludes our discussion with the post-shipment financing. And on Wednesday, we'll talk about pre-shipment financing, Exim Bank financing, how that happens. And then we'll talk about the international institutions that help out with international trade and its financing. But Exim banks are an interesting topic, and they're actually good places to work for a career. And we'll delve into their operations and what they do and how they help us with international trade financing. So again, thank you so much for working with me, and I hope to see you guys soon. And if you have any questions, please let me know. Take care. Bye now.